This module will cover limited partner due diligence management. The topics we'll be covering are people and incentives, including what considerations will be in limited partners' minds and how general partners will want to balance that relative to how they want to manage the fund. With respect to people, limited partners will look at the team's background, investment experience, and networks. It is important to note, we as limited partners closely observe the dynamics between the various team members, as well as how they complement each other. Finally, we will look at the effectiveness of the leadership. We'll look at team economics, how you expected to spend the management fees. We'll also look at the sustainability of the manager. So one key aspect that your limited partners will want to have comfort around is that the manager will be able to operate comfortably within the budget. Another aspect we'll cover is incentives and carry in particular, this being the key incentive in private equity. So this is what you're going to get back for your hard work over the years. This will not come until the very end of the fund if the investments do well. We'll also look at governance, and in particular at how the investment committee works, what is expected of its composition, and how decision-making takes place for investments. You will have had a module on how to think about developing your investment thesis. In this module, we'll look at it from a limited partner's perspective. We will also talk about how you think about institutionalizing the general partner and ensuring that the operational framework is fit for the general partner to grow sustainably over time, but also crucially, that it is fit for the purpose of managing the limited partner's capital in a responsible manner. By the time you finish this module, you should expect to have a strong understanding of what limited partners will seek from you as a fund manager.
Hi, and welcome to the Limited Partner Due Diligence Management module. We'll start by looking at some key concepts, and specifically, we'll look at the roles of the GP and the LP, the general partner and the limited partner. So the limited in LP refers to the maximum liability of an LP in the fund, which is its legal investment. The LP isn't liable for anything above the amount that it's committed. In terms of the general partner, the expectation is that the general partner will use the capital that has been committed to the fund to identify good investment opportunities and invest in them, to determine when the time is right to make a follow-on investment, if any, and also determine when the right time for exit is. It is also expected that the GP will actively manage the portfolio and participate in boards as needed and as the strategy requires. There are several touch points between the LPs and the GPs over the course of a fund's life. We have put some down here. As you will see, 3 of them are organized and 1 of them is ad hoc. With respect to the organized touch points, the key really is that you need to ensure that you're meeting, both in form and in substance, the requirements that you've set out and agreed with your LPs on in either the limited partners agreement or the limited partnership agreement, or the shareholders agreement. This reporting needs to be transparent and needs to be genuinely reflective of what is happening in the portfolio. You need to ensure that you're behaving in good faith and that there are no surprises for LPs. And in that sense, the non-organized parts of the touch points, the ad hoc meetings, are equally important in ensuring that that doesn't happen.
Part 1 we're going to cover is the LP due diligence, and this is really focused on people and incentives. The key LP considerations when they're looking at the GP, there are about 4 that we're going to discuss here. The first is the ownership of the GP, and this is for the LP to understand what has really been negotiated amongst the GP team members as to who owns how much of the company. The second point here is the evolution of ownership. The GP ownership will likely change over the years as new funds are developed, as new strategies are developed, and as the GP grows with new team members coming on. The evolution of the ownership should also show the responsibility as well as the stakes that new team members will have as they come through. The third point here is the clarity on team roles. Here, what the LP is looking for is to understand whether the ownership structure is reflecting the contribution and the roles that are held by the different partner group. Point 4 is the self-determination. The expectation is that the partner group should have control of the GP's decision-making, as well as deciding on the strategic direction that the business is going to take. And this is the GP as its own business. Now, normally, the GP is owned by the partner group. However, on occasion, a shareholding in the GP might also be held by an external party. It might be a sponsor, it might be a funder who has provided some funding or resources when you are establishing the fund in the first case, or you might be actually the manager of a pool of capital, and therefore the manager is housed within that larger asset class. The excess profits from the business usually accrue to the GP, and we're going to talk more about that and Carrie.
With respect to the assessment of the management team from an LP's perspective, what LPs really observe is a few things. First of all, the dynamic between the team members, including between junior and senior team members. Here, the objective is really to see whether this is a team that works well together, that has an ability to carry out an investment program and remain together throughout the life of that fund. LPs will also observe the engagement between the GP and both the portfolio companies, if there are any, or pipeline companies. They will also look at what the GP's wider networks are, particularly in the local context in which they're investing, whether they can call on people not to just source investment opportunities, but also to bring expertise as needed. And also, they look at the culture at the GP. Is it one where there is an ability to challenge potential decisions, to take into consideration all the different aspects that various team members bring to the fore in determining what the best use of capital is. LPs also look at skill sets and experience of the GP partnership. So we will look at prior relevant experience, including the partner's joint investment experience or other professional experience that they have gone through together. They will also look at any prior investments that you will have made, including how you've sourced investment opportunities, whether it was through your own proprietary networks or whether it was through intermediaries. They will look obviously at the financial performance, that's key, at what the ticket size and the ownership stake was, what your role was, and what value was added, both from a strategic and an operational perspective. You should be ready to discuss a whole range of issues, including the rationale for the partnership coming together, the story behind the partnership, the relationship between the partners, their backgrounds, personalities, their complementarities, the potential areas for discord. They will also look at the broader team's background, their experience, their strengths, the weaknesses, how responsibilities are divided amongst the partners and the broader team, who the key persons are, and what is the setup with respect to human capital and operational setup. Remember that here you are going to be going into a multi-year business, and so really there are considerations with respect to how you're going to be growing your business, how you're going to institutionalize it to make sure that you take care of the LP's capital that has been invested in this fund. Be ready to also discuss the specifics of your track record. So you should ensure that when you talk about track record, you talk about the specific track record in which you have taken part. So what was your specific role in specific investments? Catalog them from nose to tail and state what you did at every stage of it. Turning now to management team economics. At a high level, there are three primary areas. So the first one is management fees, which is really what allows the fund manager to keep the lights on, to meet its operating costs. Then there is the carry, which is the most important one, which is the GP's share of overall fund's profits. The carry aligns the general partner with the limited partners when things go well. If the LP's capital does well, then the GP will too. The skin in the game is what the GP commits to the fund alongside LP's capital. And it aligns the GP with the LPs when things don't go as well, because LPs will have the comfort that the GP's own capital is invested alongside theirs. So they will work just as hard for the LP's capital as they will for their own. Turning into more specifics and looking at the management fee in particular. So this is the income that is received after the fund reaches its first close. And it's generally set as a percentage of committed capital during the investment period, which you will recall is the first 4 to 5 years of a fund's life. The management fee then steps down once the investment period ends. Usually the percentage, usually probably the same percentage, is applied now to invested capital, subtracting any write-downs or write-offs. And again, I stress the fact that the management fee should cover operating costs. They're not a source of profits. Remember that the higher the management fee, the lower your net return and therefore your carry will be. So when you think about what the management fee should be, what the percentage should be as a percentage of your committed and invested capital, make sure that you set it at a level that allows you to operate, to pay rent, salaries, travel, and without hurting your performance and your carry prospect. What the management fee shouldn't include is things like establishment expenses, which are taken care of separately in the document. It shouldn't include placement agent fees or non-fund related costs or any portfolio company costs.
What is carry? Carry is the most important component of a GP's incentivization. It should also be what you should consider to be the largest source of your compensation for the work that you are doing as a fund manager. LPs will expect to receive their capital back first, plus the hurdle. The hurdle in Africa tends to be around 8%. It's only after that that they start sharing the excess profits with the GP. After the hurdle has been met, LPs will share any further upside with the GP, and that's usually split on an 80-20 basis, where they get 80% and you as a GP gets 20%. That 20% is what you keep, and it is calculated as the fund's cumulative profits, subject to the LP's capital having been returned and the hurdle also being met. This 20% is what is known as your carried interest, or carry. Other structures have been tested, and this includes having no or low hurdles or staggered hurdles, but these are some of the things that you want to take into account at the point at which you're structuring your fund. You do want to ensure that the carry split is as reflective as possible of skin in the game and the roles within the partnership and team, so that individuals who have the responsibility to drive the returns of the investments are seeing a direct line to the carry that they would earn from these activities. Do I also expect the LPs to want to see the carry allocation and the schedule of carry?
Turning now to skin in the game. As we mentioned earlier, this is the capital that the GP commits to the fund alongside the LPs. And the LP's expectation is that this amount is substantial and it reflects a substantial percentage of their own net worth. It should not be funded from management fee. This is a key point. It needs to be meaningful and it needs to align the team to the investors if the fund does not perform well. So it needs to be something that will not be easy for the GP to lose if things don't go well. Normally, we see it set at 1% of total commitments, but the key really is the materiality to the team members. And it's usually commensurate with carry allocation.
A lot of worries that may cross your mind as a first-time fund manager may include the following 4 points. The first is, will I have enough money to commit, especially since I'm already putting my income at risk with this new fund? Another worry you may have is, how much will I really need to contribute? A third is, will LPs think I'm less committed or less capable if I tell them truly how little I can afford? The fourth is, it feels like I have to put everything I have into one basket, which is this fund. Doesn't that overly expose me to a pretty high risk? But some of the things you may want to consider: really be transparent with the LPs about your net worth so you can make a realistic GP contribution. Find the right level of GP commitment. It is not a sign of weakness to say, I will not be able to afford that. So how can we make this meaningful and possible? Sometimes some LPs are more willing to have a lower than usual commitment, especially if you're a first-time fund manager. But you need to ensure that you are being open with them as to how much your assets actually are. Some GPs do bring in friends or private funders to loan them money. Do be careful of the interest or the upside terms you give these individuals or these organizations, so that you are still aligned in getting the upside of your investment, so that the carry, which is the ultimate hard work reward that you're getting, is still coming back to you as much as possible. It is increasingly possible to get specialized loans for you and the team to meet GP commitments, but it is something that is quite specialized, so you need to be careful about how you access this. Part 2, as we look at the LP due diligence, we're going to look at 2 areas, the first being strategy and the second being the pipeline. There's an entire module that you've gone through already, which was the first module, which was about developing an investment thesis which is viable. As you think about it when you're going through the investor due diligence piece of this, there's some things that we want to emphasize. Strategic clarity is really one of the key drivers of success for fund managers. If you are not able to be clear about what your product is, and you're not clear about the investment thesis, it is very hard to build from there. So do make sure that the investment thesis is based on the team's core skill set, your track record, and be consistent throughout the fund's investment period. Be focused, targeted, and ensure that your investment thesis is based on your skill set and the track record of the partners. When we say have your thesis be focused, know exactly what space you're good at playing in, because the LPs are going to interrogate that. Think about the value add. How are you going to do more than just provide cash? How are you going to add value? Are you only going to be financial investors, or are you going to be operational partners? Think about how you're going to highlight to the LPs the strength of your local networks, and that you have got local knowledge, and that you are plugged into local business networks. You want to ensure that your fund thesis is strategic, which means you should be comfortable and consistent about the sectors that you've chosen to focus on. When we say strategic, we also mean be consistent in the strategy for the opportunity set, for example, growth in particular sectors. In terms of portfolio construction, think about portfolio construction with a view to building a well-balanced and a diversified portfolio. You want to give yourself the chance to have the best outcome you can for the entire fund investments. Finally, you want to ensure that your thesis, when you are discussing this with your LPs and going through the due diligence, is very much reflective of the skills and the track record of the team. So you want to be clear on what the exit opportunities are and what the strategy is from the beginning, so that it ties together. For first-time fund managers, you want to beware of a few things. The first thing is presenting a thesis where the opportunity set is too generic. Some common ones are, we are pursuing Africa's demographic dividend and the growing disposable incomes that we're seeing on the continent. Everybody's saying that. So you need to be clear about what that means in the context of your own investment thesis. Be careful about venturing into unfamiliar areas, because if you can't answer the questions that the due diligence is throwing up, that is going to put doubt in the minds of the LPs. Be careful about an excessive focus on greenfield investment opportunities, which are startups effectively. These are very challenging when you are talking about investing from a PE context. And investing is not the same as investment banking. So PE investing is very much about a long-term view on value creation. Finally, value addition is absolutely key. LPs want to make sure that you've thought about this and that you've built this into your strategy and that you're bringing in the right capabilities which are relevant to help these businesses. By the way, those capabilities could be internal to the organization, to your GP, or they can be external. It could be actually consultants.
Turning now to the investment process, how you build and execute on your pipeline. So it all starts with origination. This is what we were talking about earlier in terms of the proprietary networks. How do you identify potential investment opportunities? Do you do a top-down or a bottom-up approach when you look at the market? And just understanding, and LPs will want to understand how that takes place. Usually there is then a second stage, which is the go, no go decision with respect to whether an investment opportunity is taken forward. This is usually where the partner team generally comes together and decides whether resources should be spent on a particular deal. If it still seems like a good investment opportunity, you will normally go to a screening IC where you present the deal to the investment committee, providing the basis for an in-principle decision regarding a new investment. It usually allows the team to start incurring more substantial due diligence costs. Normally, after the go, no go, some costs might be incurred, but really the screening allows you to start spending money on advisors, for example, or consultants. And then there is the final IC where the findings of the due diligence are presented. It usually serves as a basis for taking a final investment decision. And normally there are a few conditions to be fulfilled before the investment actually is made. And finally, at the end of the investment's life cycle, from a PE perspective, there is an exits investment committee where the exit proposal and terms are presented for a decision, and the decision to sell an investment company and a portfolio company is made. With respect to the investment committee, there are a couple of things to note. The first one is the composition. So generally, what we tend to see is the entire partner group and generally 2 independent IC members. Sometimes there will just be the partner group with potential ad hoc attendance of external experts for certain investments that are in certain sectors where additional expertise from outside the team might be helpful. Most limited partners tend to see independent IC members as a positive sign, particularly for first-time fund managers that might still benefit from having outside input from experts in either that have a particularly significant local context or more general investment skills, depending on what the partner's skill set is already. And then for more established GP platforms, this is where you tend to see more often in-house investment and operational expertise that is already very embedded. There is a wide partnership that can draw on a lot of diverse experience. And so in those situations, you might see a partner-only investment committee. And then just one note about decision-making. Usually you will see either a unanimity or majority vote. So in the unanimity, obviously, it's great because it has the full buy-in from the partnership. At the same time, it could hold up an investment where in a situation where one person can basically hold the committee hostage because the deal cannot go through without its permission. And then finally, but on the other hand, the majority vote has obviously the benefit of a deal passing through as long as there is critical mass, but it potentially opens up a situation where there might be a split in the team view. What we normally tend to see is that regardless of what the letter of the investment committee process says, in general partners are uncomfortable with proceeding with an investment opportunity if there isn't sufficient comfort from all investment committee members, whether that's formal or informal, whether that's formally or informally communicated. Turning now to part 3, we will look at the operational side of the GP. Part 3, we'll now look at the LP due diligence on the operational side. So we're really talking about building the fund manager's business. The LPs in a PE fund are investing in a blind pool, i.e., they don't know at the outset where their capital is going to be invested. Therefore, it's critical for them and for us to understand how the fund's operations are run, because they want to ensure that their money is being taken care of in a way that is both responsible and in compliance with relevant laws and regulations. From the GP side, you need to be able to show that you're thinking about building your business as an institutionalized, lasting institution that will rest on an operational setup that will allow it to grow and flourish in the long term. And there are 8 main building blocks. The first one is compliance, and under this fall quite a number of issues, including the compliance manual, which will detail policies and procedures, including supervision, monitoring, enforcement. There will be a code of ethics that will include an insider trading and personal trading policy, and also, importantly, language prohibiting unethical activities, such as deception and fraud. There will be a conflict of interest policy, defining and identifying all possible conflicts with procedures for reporting, management, and disclosures. This is key to LPs. It goes at the heart of the trust of the contract of trust between limited partners and a general partner. It will be important to see that the relevant regulatory filings have been made, identifying the entities that are regulated, and identifying also the name of the regulators that supervise them, and that there is an anti-bribery and corruption policy, sometimes called ABC, which will prohibit transfer of any remuneration or cash to any person without prior approval of the CCO. And then it's critical that there is an anti-money laundering and countering the financing of terrorism policy, and internal controls in place.
Moving on to the next point here of the critical building blocks, as Carlotta was talking about, you've got information technology, IT. Here, what the LPs want to understand is that you've got the key systems in place in terms of the resources you're using, the key software, systems, etc. Another aspect is cybersecurity, and this is really becoming more critical in the global world in which we live, and knowing that there's confidential information that is going to be retained in your relationship with your portfolio companies as well as your LPs. A third is disaster recovery and business continuity. And this includes having insurance in case anything happens, and you're able to then ensure that the information that you had on your computers is able to be recovered. The fourth is data protection and GDPR. Many of your LPs are going to be from different parts of the world, and they will be subject to regulation around data protection in their jurisdictions as well. So you want to ensure whatever you set in place as the IT platform is something which is capable of surviving a due diligence review by your LPs. The next part of this is human resources. We've already talked about the ownership piece. So let's talk about compensation. Here, what the LPs are going to be looking at is how are you thinking about the compensation? Are team members being fairly compensated? Is it linked to expected outcomes? You want to think about how you're effectively building out the HR function within your business. Also, they will be looking at employment practices, performance management systems, etc. So you want to ensure that you have your HR manual. And the sooner you get this done, the better it is as you're going through a due diligence by an LP. The next area is administration. Here we're talking about fund administration. So this is depending on the fund structure that you have in place, what is the legal structure and where is it domiciled? For many funds which are operating in Africa, the domicile tends to be Mauritius. In-house or third party, normally it is a reputable third-party administrator. And what happens is they are also diligenced by the LPs. They want to ensure there's adequate resourcing, there's strong software, and that there is another check in the chain of transactions between you and them as LPs. They will also check the accounting software there, the administrator's accreditation, and the investor reporting process. The next area is finance. And here we're looking at 4 areas. The first is cash management. Do you have a dedicated bank account? And what are the main inflows we're talking about here? These are capital calls and receipts from investees. The main outflows include the repayment of investments. There's also the custody of fund assets. the budgeting process, and the audit. The next area here is valuation. And your LPs are going to agree with you ahead of time what the valuation methods are going to be. This has become quite standardized practice. And you want to ensure that you are able to demonstrate both knowledge of and practice of the right way to value a company and report that back to your LPs. There is also going to be sometimes an independent valuation process. And sometimes some LPs will eventually do a valuation audit. So you want to be prepared for that to the extent that you can be. The standardization and the consistency of the methodology. Usually, the ILPA reporting templates are used and IPEV valuation guidelines. These valuation standards are usually aligned to IFRS or US GAAP accounting practices. Under legal, you want to have a very active process here, because starting with the litigation history, you want to disclose when you're going through due diligence with your LPs, any previous and any potential litigation or threat of litigation. But it's not only when you're going through the due diligence that you want to disclose this, because this is something you need to disclose on a regular basis. So at this point, what you want to do is ensure that you have a process that shows that perhaps if there is a potential litigation in play, but with an employee who is involved, that employee has to inform the company, inform the GP within 24 hours or within 3 days. And then you decide how quickly you will let the LPs know about this. You also want to be clear on how disciplinary issues are going to be addressed. And this is both with team members as well as advisors to your fund. The KYC or the reputation management, this is so critical for LPs. And we'd recommend that you apply the front page of the newspaper test. What does that mean? It means make sure that you're keeping your reputation clean, and anything you're saying, you're doing, you're disclosing is something that would be fine if it appeared on the front page of a newspaper. You also want to ensure that the legal function is independent and the governance of it is independent. Finally, the documentation is really important, and the strength of the documentation should be such that it can go through an audit by your LPs. The first part of that is actually, to some extent, the due diligence that you're going through at this stage of the process. So you want to ensure that the processes are established, either outsourced or in-house, for how you are documenting everything associated with your fund. Insurance is really important, and there are different types of insurance that you need to think about getting for your fund. And this is not just for the GP itself, but also the underlying investment vehicles or the structures. And this includes D&O insurance, which is directors and officers insurance. And this is especially important for the team members who are sitting on boards of portfolio companies. Then you've got professional indemnity insurance, and finally, employee and property liability insurance.
Just to conclude, we thought it would be helpful to just reflect on a few tips for managing your LPs throughout the due diligence process, but also more broadly. And probably the most important one is that of thinking of the relationship with limited partners as a long-term one. You're effectively entering into a marriage that will last probably at least 10 years. And like any marriage, if it ends, if there is a divorce, it will be painful and it will be very expensive. So think about building a partnership built on trust that is ready to last to withstand the test of time, that can last for many years. Think of your LPs as resources. We can help you build your institution. We have seen a lot of GPs. We have seen a lot of different structures. We have seen a lot of teams that have worked and those who haven't. And chances are our networks will be helpful to you as you try and build your business. Remember that transparency always pays off. This relationship is based on trust. There is a set of legal documentations that enshrine what the partnership is about, but really it is one about trust. You have to set expectations early on and clearly. You need to communicate often. You need to be able to ensure that there are no surprises. A breach of trust can be fatal to a GP. It will mean that investors will think twice before investing with you again, even in the context of good performance. Pay attention early on to investor communications. Whether you have an investor relations department or not, it's important to maintain that channel open. And make sure that communications are both formal and informal. Again, I stress again, it's a partnership based on trust. And trust gets built over time and with open and frequent communication, both formal, informal, in person, over the phone, over Zoom, as it might be. And with that, good luck. And we look forward to seeing your pitches very soon.